Well, hello. Welcome to the second session. And what we have here today is 3 great papers on capital requirements and the best design for capital regulation, how that impacts on smoothing credit lending and avoiding, hopefully, bank distress at the time of crisis. So we will start with Jan. The floor is yours. You have 20 minutes.
Okay. First of all, thanks a lot for the conference organizers for inviting us to present here. So the paper I will present is entitled The State-Dependent Impact of Changes in Bank Capital Requirements, and this is joint work with Dominic Menno from the Bundesbank. So given that we work at institutions, the usual disclaimer applies. So what's the structure of my talk today? So I will start out with a brief motivation and an overview of the key results. Then I will present the structural model setup. And then in section 3, I will provide the key results of the paper. And finally, in section 4, I will conclude and provide some policy implications. So what's the motivation for our paper? If we look at the data, we see that the impact of changes in bank capital requirements is actually state dependent. So a 1 percentage point increase in capital requirements tends to have close to a 0 impact on lending in good states. So whenever banks make profits, they have voluntary capital buffers or the macroeconomy is doing well. So you see that illustrated in the left-hand side chart. You can also see from that chart that if you're in a bad state, so where banks don't have buffers or make losses, the same increase in bank capital requirements can actually reduce lending by a few percentage points. So in the data, there's evidence for the state dependence of changes in bank capital requirements. And the second motivation is that if we look at standard macro models with the banking sector, they often lack this feature of state dependence. So if you look at the table on the right-hand side of the slide, you can see a summary of the quantitative impact of a 1 percentage point increase in capital requirements on the lending reduction. So we have borrowed that table from a recent ECB paper. And you can see that in most of these models, so many of these are used for policy evaluation in institutions, there's a constant lending response of 1 to 1.5% in response to a 1 percentage point increase in capital requirements. So we use this as our motivation to build a structural model with state dependence. So our key result is that indeed there's strong state dependence, and the impact of a change in capital requirements on lending can actually differ by up to 2 orders of magnitude. So the differences of state dependence can really be huge. So what do we do? In our paper, we build a nonlinear banking sector equilibrium model, and this model features monopolistic competition, and it also features the fact that bank equity is always more costly than bank debt. So this assumption will tend to make it quite costly to increase capital requirements. So whatever we do in the model, interpret this as upper bound. So we're making quite conservative assumptions. And then the key model block that gives state dependence will be that we introduce 2 occasionally binding constraints. So we have a capital requirement constraint and a constraint that banks cannot issue equity. So they cannot go to the market and issue equity. They can only build equity through retained earnings. And really this interaction of the 2 occasionally binding constraints is what will yield strong state dependence in the model. In particular, what we find is that in normal states where banks hold voluntary capital buffers and make profits, there's actually a very low impact of an increase in capital requirements. So 1 percentage point increase only leads to a drop in loans of up to 0.1%, and it can even be lower than this impact. However, if you're in a bad macro-financial state where banks make losses and they become capital constrained, you actually get a very high impact of changes in bank capital requirements on lending. So a release of requirements by 1 percentage point can increase loans by up to 10%. So these are really the 2 orders of magnitude difference. And the key question is what's the intuition behind these very different magnitudes? So we show that in normal states, when banks basically have enough equity, a pricing channel is active. So basically whenever banks have the equity to satisfy higher requirements, the only impact on loan quantities is that the average funding cost of a loan increases because equity is more costly than debt. And this is passed on to customers, and you move up the loan demand curve. But this effect is really super small. However, if you're in bad states, where banks make losses and they basically hit their equity constraint, a quantity channel comes into play, because basically the available equity and the requirement directly determine the maximum loan quantity that banks can supply. And basically then, in these states, if you change the requirement, you can have a very large impact on loans. So, in the interest of time, I will not go into the details of the related literature, but you find all the things in the annex. And for the remainder of the talk, I will go into more details of the model and show you the technical details behind this state-dependent impact. But basically, the intuition you already have, and it's on this slide. So, how does the model look like? We have a fairly stylized but realistic bank balance sheet and profit and loss account. So on the asset side, the bank has loans. On the liability side, they have deposits and equity. And the profits of the bank are simply given by the difference of net interest income minus the cost of risk, so impairment costs and operating costs. So let me say a few more details about net interest income. Net interest income is simply interest rate on loans times the loans minus the deposit interest rate times deposits. Cost of risk is simply that we assume that a time-varying fraction theta of loans default every period. So this is the stochastic variable in the model. And operating costs are simply a constant fraction of balance sheet size. So this scales up linearly. And importantly, the interest rate on loans that the bank is able to charge will be endogenous. So in the annex, you will see how we model the loan demand side, but we basically have a downward sloping, constant interest rate semi-elasticity aggregate loan demand curve. And we assume monopolistic competition. So this will lead to basically an endogenous interest rate that depends on the loans that the bank supplies and the aggregate loans in the economy. And as I've mentioned before, the impairment rate is stochastic, and we assume that it follows a log AR1 process, and we assume log AR1 because in the data we see a fat right tail of loan impairments, and to get that fat right tail, you need a log AR1 and not a AR1 in levels. So on this slide, I'm basically summarizing the key two occasionally binding constraints that will yield state dependence. So first, note that equity is built through retained profits after accounting for dividend payouts. So equity next period is simply given by equity this period plus the profits the bank makes minus the dividend payouts. And importantly, dividends are the optimal choice of the bank. So the bank chooses how much to pay out, but there's a constraint and they cannot issue equity. So dividends cannot be negative. The second occasionally binding constraint is that there's a potentially time-varying capital requirement R, and this must be met by the banks all the time. So the capital ratio, which is defined as equity over risk-weighted assets, so omega is the risk weight of the assets, the capital ratio needs to be greater or equal than the requirement at all times. And the interaction of these two occasionally binding constraints will yield this very strong state dependence. So what is the objective of the banks? Banks maximize the present expected discounted value of dividend payments, and they discount, or the discount rate that they apply is determined by the required return on equity. And we denote this by rho, and we assume that it's constant and it's always greater than the deposit funding cost. So this is quite a conservative assumption and will tend to make it costly to increase bank capital requirements. But as we will show, still in normal states, the cost will be very low. So the decision problem of the bank can be represented by the Bellman equation that you see on the slide. And the state variables of the value function are theta, which is the credit risk shock, loans of the bank, equity of the bank, and the aggregate loans supplied by the entire banking system. And you can also see that on the right-hand side of the Bellman equation, you have the two occasionally binding constraints. So the capital requirement constraint has the associated Lagrange multiplier chi1, and the equity issuance constraint has the associated Lagrange multiplier chi2. And the equilibrium of the model will be determined by the first-order conditions to this decision problem and imposing the representative bank assumption. So in equilibrium, the individual choices need to be consistent with the aggregate. So let me turn now to the key results of this framework. So I will present analytical insights, but also quantitative insights based on a calibrated model to euro area data. And importantly, we solved the quantitative model with global solution methods so that we get the full nonlinear dynamics of the model. So the first insight of the paper is that there's a pricing channel of changing bank capital requirements. And proposition 1 states that in the absence of an equity issuance constraint, equilibrium loans respond to changes in capital requirements via a pricing channel. So what you see there in the equation is that the percentage change in loans is equal to the right-hand side expression, which might look complicated, but actually has a fairly intuitive interpretation. So let me walk you through this. So if there's no equity issuance constraint, banks can always go to the market and get new equity. So the only impact on loan supply is that the weighted average funding cost of a loan increases. So you need more equity to finance the loan. Equity is more costly than debt, and this is basically increases the funding cost. And that's what you see in the square brackets on the right-hand side of the equation. So rho minus ID is simply the premium you pay on equity, and omega times delta R is simply the additional amount of the loan that you need to finance with equity. So basically the square brackets give you the additional or the increase in funding cost. What's important to notice is that actually the impact on funding costs will, for realistic parameter values, will be super low. So if you plug in an 8% cost of equity, a 2% cost of liabilities, 50% risk weight, and a 1 percentage point increase in capital requirements, you end up with an increase in funding costs of 3 basis points for the loan. So this is an eighth of a standard monetary policy rate hike. So in terms of increased funding costs, that's almost nothing. And due to monopolistic competition, banks will pass that on with a markup. So that's why you have mu over mu minus 1 in the equation. But this markup will also empirically will not be that high. And then the impact on equilibrium loan quantities will depend on how elastic loan demand is to this increase in offered lending rates by the banks. But empirically, we also know that loan demand is not too elastic. So a reasonable estimate is around 3 for this interest semi-elasticity. So if you put together all these numbers, you end up with a minus 0.1% in loans for 1 percentage point increase in capital requirements. So this result is for the model where you don't have the equity issuance constraint, but importantly, we show that a similar proposition can be derived for the full model for states where the banks actually hold voluntary capital buffers before a capital requirement increase and after. So if banks have enough capital to basically absorb the increase in capital requirements, a similar pricing channel will be active. And the key message about the pricing channel is that whenever that is present, the impact on lending will be super small. And we use our quantitative calibrated model to illustrate this. So what you see on the chart is basically the simulated impact of a 1 percentage point increase in capital requirements on lending. So that's on the y-axis. On the x-axis, you see the relative frequency of the simulated impact. And what you see is basically whenever banks hold voluntary capital buffers but do not pay dividends, so those are the red bars, basically a 1 percentage point increase in requirements will only lead to a drop of minus 0.1% in loans, so quite low. But importantly, if banks are also paying dividends before and after, so they basically already hold the optimal voluntary capital buffer, the impact on loans is almost zero, so it's very close to zero. So it basically means whenever banks hold voluntary capital buffers before and after changing capital requirements, the impact at most will be minus 0.1, and it can even be lower. So it's almost, very, very low. The second key result of the paper is that there's a quantity channel also of changing capital requirements. And proposition 2 states that in states of the world where the equity issuance constraint and the capital requirement constraint are binding, the equilibrium loans respond to changes in the requirements via this quantity channel. And the quantity channel states that the percentage change in loans needs to be equal to minus the percentage change in the requirement. And again, what's the intuition behind this quantity channel? So if both constraints are binding, it means that banks don't hold voluntary capital buffers, and it also means that they don't pay dividends. And in these states, the loans that the bank can supply is determined by the equity they have, the profits or losses they make in the period, and the capital requirement. So the equation there, I simply plugged in these values, and you see that basically R prime and L prime are the only two variables that vary. So if you change the requirement, it directly impacts the maximum loans that the bank can supply. So the key message about the quantity channel is that the impact on lending whenever this channel is present will be very large. So whenever banks are capital constrained, a 1 percentage point release in capital requirements will lead to around a 10% increase in loans. And where does this 10% increase in loans come from? If you look at the quantity channel, it's simply percentage change in loans equal to percentage change in requirement. And given that the requirement is usually around 10%, a release by 1 percentage point means roughly a 10% change or reduction in the requirement. So we also use our quantitative model to simulate the quantity channel. So assume a bad shock hits the economy, impairments go up a lot, so you see that in the middle panel. This will actually induce big losses for banks, and the losses push the bank towards the capital constraint. So the constraint becomes binding, and they're forced to deleverage. And you see that represented by the red lines. So basically under constant capital requirement, banks will be forced to deleverage a lot. So if the regulator actually is able to release requirements in these states, this helps the banks to absorb the losses and it mitigates bank deleveraging. So those are the blue lines compared to the red lines. So of course, a key question is then what kind of capital requirement rules help you to prevent that this quantity channel is basically absent whenever you activate capital requirements and that it's not there in the bad states. So proposition 3 states that policymakers can avoid the quantity channel with capital requirement rules that satisfy that the requirement never turns negative, and it needs to satisfy the following condition in all states. So the requirement needs to be smaller than the beginning of period capital ratio plus the return on risk-weighted assets adjusted for a desired loan growth rate of the banks. And again, what's the intuition behind this rule? Well, basically, the return on risk-weighted assets and desired loan growth, they determine the speed limits for how quickly banks can change their capital ratio. So when profits are positive, a gradual increase in the capital ratio is possible for the banks, and therefore you can gradually increase the capital requirement. The reverse is that if there are losses, a release in the requirement will be needed so that basically you allow banks to accommodate the decline in the capital ratio without forcing them to deleverage. So we use our quantitative model to implement a simple state-dependent rule that is consistent with this proposition. And most importantly, the state-dependent rule will build up capital buffers when the costs are low. So when banks make profits, you gradually increase the requirement, and when they make losses, you release. What you can see in the chart is basically the result of 100,000 simulated economies for transitioning from a 10% constant requirement to this time-varying rule that varies requirements between 15 and 10%. So the blue shaded areas give you the percentile ranges across these 100,000 simulated economies. And what you can see is that the state-dependent rule will provide large gains at fairly moderate costs. So basically, on the right-hand side, you can see that after 5 years of having the state-dependent rule in place, basically the credit crunches are gone, so you really cut off the lower right tail of the loan distribution, and at the same time, basically the upper percentiles of the loan distribution are hardly affected. So this basically shows if you do this state-dependent rule, you basically don't do much to loans in the normal state, but you avoid that you get occasional large deleveraging. So let me finally provide sort of a brief overview of what the policy implications are. So in our view, the paper provides a clear rationale for positive neutral countercyclical capital buffer strategy, CCYB strategy, and in particular that you should start to build positive buffers when banks make profits because the costs you will impose are very low. So when and how should capital requirements be increased? When the banking sector makes profits, this is super easily observable. How should it be done? Fairly gradual, because the speed limit for increases in the capital ratio will be given by ROA and desired loan growth. And this is super easy to implement because basically dividends tend to be paid out of past year profits, and also the CCYB is phased in with basically a 1-year time lag. So if you observe profits, you can basically increase the requirement based on observed profits, and it should not constrain banks. In the interest of time, I will stop here, but basically, yeah, release when banks make losses, but this will be a bit harder to implement. So thanks a lot for your attention, and I hope you found the talk interesting.
Thank you. So we have Galo Nuño from Banco de España discussing this paper. Thank you.
Thank you very much. So, okay. So, I mean, this is a very interesting paper that addresses a topic that I think needs to be addressed, which is most of the macroeconometric, I mean, models, tools that we have at central banks, and also in the academia, in order to deal with macroprudential issues, are typically based on linear models. And this is kind of a big gap because, in terms of monetary policy, it's different because inflation is kind of a continuum phenomena. Now we can discuss whether, high inflation regimes are different to low inflation regimes. But in terms of macroprudential tools, there are very strong nonlinearities operating. And the beauty of this paper is that in a relatively simple approach, it tried to address these shortcomings from the point of view of analyzing this kind of state dependency associated with the behavior of banks in response to changes in the capital ratios. I wanted to start with a simple, because the paper has several elements, but at the end of the day, it can be a strip off of most of the bells and whistles in order to focus on the key mechanisms. And then essentially, this is why I wanted to start with a very simple, kind of toy model. It's a simplification of the model in order to understand how those two channels operate. It was very helpful for me. So let's start first with the quantity model. So imagine that the capital constraint is binding for a bank. So you are really hitting the capital constraint. Then, if the bank's capital is constant, so it cannot issue new equity, it cannot issue new capital, and this is an important if assets are short term, then if you increase the capital ratio, automatically the bank is forced to deleverage and reduce the assets. So that is pure accounting, in the sense that, if I have to satisfy that at a share of my assets are covered by equity and I cannot issue new equity, and now you ask me to increase the share of my assets that have to be covered by the same amount of equity, and I cannot default, and I can instantaneously or in one period reduce my assets, then I will deleverage. And essentially, the percentage share of the deleveraging in assets is proportional to the increase in the capital ratio. Then, if now I plug that into a demand curve mapping interest rates with quantities, then I will get which is the impact on the impact of that reduction in interest rates, which will be just proportional to this to the semi-elasticity that linking quantities with interest rates. Okay, so that is the quantity channel. The quantity channel essentially relies on these two key assumptions. One is the issue that you are at the constraint, and second, that you cannot issue new equity, and especially that your assets are short term, so you can deleverage. Then now we move to a different scenario. Imagine now that a bank can issue all the equity that it wants, or that it holds a voluntary capital buffer. Then the bank is facing a very simple problem. Here we can illustrate it in a two-period case, but it's very similar in a multi-period model. Essentially, I mean, you want to maximize the flow of dividend in this period and in the next period, and essentially you are facing the net interest income. The other costs don't play a role in, I mean, they play a quantitative role, but in order to understand the mechanism are totally relevant, the same as monopolistic competition. Actually, in the calibration, papers are almost perfectly competitive. So this is not about monopolistic competition, this is not about any kind of cost. It's super simple. It's essentially, you have this, that the dividends are just the net interest income minus the change in capital, because, I mean, you want to decide endogenously to devote a part of your profits to increase or decrease your capital. And then subject to the constraint, then the first order condition just give you this pricing channel. So they are just giving you this mapping between the difference between the deposit interest rate and the discount of the bank multiplied by the change in the ratio. So if we compare both slides. Thank you. If we compare both slides, you see that in one case there is kind of a -1 mapping from the reserve requirement to the change in assets, whereas in other case, this, instead of a 1-to-1 mapping, this mapping is multiplied by epsilon, rho minus ID, and omega, which essentially it is multiplied, I mean, about a difference between two interest rates. So we are multiplying the quantities by a difference of interest rates. So then that makes kind of obvious that this channel is going to be proportional to this interest rate. So it's going to be 2 orders of magnitude smaller than the quantity channel. Okay, so that is my reading of the paper. Then when you analyze the whole model, dynamical model, then they have super beautiful pictures, and I should say that I like even more the presentation than the paper in terms of how things can be understood. But this is the idea of the paper. So essentially what we are going to have is it's the banking system that is hitting from time to time this occasionally binding constraint. Then I have 3 comments. The first one is whether banks deleverage so fast as in the model. The second is whether bank heterogeneity can be used to support the results. And the third is how relevant is to miss the endogenous deposit funding, because this is a channel that is automatically shut off in this paper. About the deleveraging. As I said, an important assumption of this paper is that it has a short-term asset structure and that banks do not default. So then, if you imagine, for instance, that a large negative shock arrives, then banks can immediately deleverage. So essentially, there is this super strong mapping from the ratio or from the equity impact to the asset side. But the question is, in reality, banks engage into maturity transformation, and most of their assets are long-term. So then it is not that clear to me that this process will be that big. And if it is that big, that would have to be something dynamically. The bank cannot deleverage so fast. So it would be some kind of dynamic deleveraging over a number of years. So that is, from a quantitative point of view, that is something to be taken into account. The second is the issue of bank heterogeneity. If we have a look to the distribution of capital ratios, very few banks are close to the regulatory ratio. So then the question is, how realistic is to, of course, you may say that the assumption that banks are, the banking sector as a whole, because this is a model with a representative bank, is slack or is hitting the boundary, it can be used as kind of a proxy of which share of the mass of this distribution is close or not to the boundary. But if that is the case, maybe the empirical data can be used in order to see whether banks that are closer to the boundary behave more as in the quantity channel, whereas banks that are farther away from the boundary behave less as in the quantity channel and more as in the pricing channel. That would provide really some convincing evidence about the importance of those regimes. And then the third one is that the paper makes a point about the link between the regulatory ratios and the interest rates on loans. But then it artificially keeps the interest rate on deposits shut down. But however, if you also make that endogenous, I make some, I think I didn't put it in the end, but you get this kind of dynamics about this kind of deposit channel of monetary policy, in which the increase in the ratio, the increase in the regulatory constraints, on the one hand, as it happens in the model, increases the equity and reduces the loans, but then in a second stage, as you deleverage, you also require less deposits, and then that changes the competitive situation in the deposit market, so that reduces interest rates on deposits, and then increases the net interest income, and that helps to recapitalize the bank, and then increases the loan. So, it's very clear that an increase in the regulatory ratio is going to increase the amount of equity, but the effect that it's going to have on the loans will depend on the relative strength of whether the impact through the loans is stronger. In this model is totally stronger because the other is shut off, but in reality it will be a race between the elasticities in the loans and deposits. And then to conclude, this is a very cool paper. As an advice, the paper is nice because it has both analytical results and quantitative computational ones, and the quantitative computational ones, it's not something that can be done in a couple of evenings because it's a fully general equilibrium nonlinear model. But there is a certain tension about whether the paper wants to just illustrate a mechanism or really talk about the real numbers in reality. Then it would also be nice to have more evidence about this state dependency in the data, because the paper based to use that, which is this paper by Jimenez et al., it's more about credit demand and loan quality, but not that much about banks and the regulatory constraints. And that's it. Thank you very much. It's a very nice paper to read, very well written, and thank you.
Do you want to?
Yes. First of all, thanks a lot for the discussion and the kind words. Let me briefly respond to the 3 comments. So, yeah, it's true in our model, banks deleverage instantaneously because we basically have one period assets. This was done deliberately because it allows us to have the model simple and tractable and derive analytical results. Of course, in reality, there will be some friction, so you can also introduce adjustment costs here. And the thing is, if you take it to the extreme and banks basically have only long-term assets, what will happen in the cases where they can't deleverage is basically they would default. And to keep solving a model with default and that nonlinearity is even more complicated than what we're doing now. So we're fully aware of what you said, and to make it quantitatively super realistic, probably some form of adjustment costs will be needed, but to get analytical results and intuition, we try to keep it tractable and focus on the key mechanism. Similar for bank heterogeneity, so we kept it on purpose with a representative bank. I think the impact of heterogeneity on the results will depend on what you assume about substitutability of loans across banks. And I think one point that we really want to make with the paper is if you increase requirements gradually when banks hold voluntary capital buffers, the impact will be low. And I think as long as the majority of banks are in such a state, the impact will be low, and I think this is really what we want to convey to policymakers. Don't be afraid to increase requirements in states where basically banks can absorb that. Deposit rates, if you make the deposit rates react to capitalization, the pricing channel would probably be even less than what we derive. So this is really a conservative upper bound, and you can even have more beneficial impacts of higher capital requirements. So again, we try to make it as hard as possible for increasing capital requirements to actually have low costs. And even with those very strict assumptions, we show that it's actually not that detrimental. So, but yeah, for fully realistic quantitative model, that's definitely something to consider.
Well, don't we stop here so we can get some questions from the audience. David?
Thank you. Thank you very much. It looks like a very nice, clean paper. Thanks a lot. One question, how much does the relative cost depend on the level of the capital you have? Because it looks like the deleveraging is going to depend a lot on what's the starting level of capital. Mm-hmm. So basically, if you can comment a little bit on that, I would appreciate it. Thank you.
Okay. Okay, now it's working. Okay, thanks for the paper. So I was wondering if you could comment a little bit on your assumption that banks cannot issue equity. It seems to be quite strong to me. So what exactly do you have in mind? Is it related to the timing? Is it some form of debt overhang? And it seems to be that should be related as well to your policy implications down the line. So wondering if you could comment on that.
Thanks. Really, really great paper, and speaks a lot to the paper that I presented this morning on sort of low versus high surplus. And I was going to make a comment on Gallo's point about the distribution of capital ratios and how it doesn't seem as though many banks are close to their sort of regulatory ratios. I wonder if voluntary surpluses are also state dependent, and I wonder how that impacts the point at which capital constraints bind. And I wonder if there's a way of incorporating that into the model. Because I wonder if once a shock hits, banks may all of a sudden decide that they prefer to have greater management, but for sort of voluntary surpluses, and therefore may become capital constrained even if they're not right on the border. Thanks.
Thank you. Do you want to?
Sure. Well, thanks a lot for the interesting questions. So how much does the impact of our two channels depend on the level of capital? So the short answer is, for the pricing channel, basically doesn't really matter because it's only the delta. For the quantity channel, it matters because it's about the percent change in the capital requirement. So if you have a very high capital requirement, then the quantity channel will be smaller. If you have a very low capital requirement, quantity channel will be higher. So for the quantity channel, the level matters. On equity issuance, indeed, it's a strong assumption to assume no equity issuance at all, but you could relax it and say equity issuance is possible, but it's costly. So that will still lead to state dependence, because in the good states where banks make profits, you will not face this equity issuance cost. You will still get state dependence. The intuition will probably be that the magnitude of the quantity channel will be lower, because it could be that banks are actually not that much actually capital constrained, but of course their marginal cost of providing a loan increases if you need to pay a very high cost to issue equity. So you will still get state dependence, and importantly, the low cost of increasing requirements in the good states or normal states will be unaffected. Then on heterogeneity and voluntary buffers. So we don't have heterogeneity in the model, but we have voluntary buffers in the model, and they're basically optimal choice of the bank. And interestingly, actually we have we have counter-cyclical voluntary buffers. So in the bad states, the self-insurance motive of the bank increases. So if risks are higher, they want to hold higher voluntary capital buffers, which is actually the opposite to what you want from a macro perspective. So this is basically what we show in the paper is that the self-insurance that banks do is not enough to avoid that they occasionally face basically deleveraging pressure, and that's why as a regulator you want to put in place higher requirements in the normal states so that you actually can release in the bad states, because the banks voluntarily, they will not do enough self-insurance. Yeah, I'll leave it.
Well, thank you. Thank you very much.